she's dependent on the kindness of strangers. And we don't want to be dependent on the kindness of friends even.
There is always lots of buzz around Warren Buffett's Berkshire Hathaway meeting, and you've probably already seen a ton of videos covering his comments on his airline investments and his opinions on share buybacks. So instead of repeating what has already been covered thoroughly, I sat down and watched the entire 2-hour Q&A session to find these 5 critical investing lessons that Warren Buffett has used throughout his life in order to deliver above average returns. So with that said, let's jump into the first clip.
When we sell something, very often it's going to be our entire stake. I mean, we don't trim positions or that's just not the way we approach it any more than if we buy 100% of a business, we're going to sell it down to 90% or 80%. I mean, if we like a business, we're going to buy as much of it as we can and keep it as long as we can.
When Warren Buffett is analyzing a company as an investment, he either likes the company and wants to hold a lot of it, or he doesn't like the company and he doesn't want to hold any of it. If Warren Buffett doesn't have complete conviction in the investment, if he does not truly believe through his thorough analysis that this is an investment that can safely return him an above average return, then he doesn't trim his position. He doesn't reduce his exposure to a business that might go out of business in the short term or that might not deliver the returns he expects over the long term. He doesn't trim a position. If he no longer has confidence or conviction in that investment, he completely removes it from his portfolio and focuses on finding businesses that he does have complete conviction in. Warren Buffett follows a philosophy of only investing in businesses if he is sure that he can make money. And that is the way that you should also think about your investments when you're putting money into a business. If you're investing in a business and you have a portfolio of 40 or 50 different businesses and you're adding the 41st or the 51st business into that portfolio, really think about whether you are confident that and sure that that business can make you money over the long term. And if you don't understand the business, or it has too much debt, or if the short term is too uncertain for this business, then that is a business you don't want to add to your portfolio. Stick to businesses that you deeply understand and that you have confidence and are sure that it is at the least not going to lose you money, and then hopefully that it will deliver an above average return for you over the long term by your calculations of what those future cash flows will be.
We don't have short-term financing at any degree. We'll never get ourselves in a position where we have a lot of money that can come due tomorrow. And people that were financing heavily with commercial paper and then found their business stopped, well, you've seen what's happened to the airlines. I mean, they need money. Cruise lines need money. There's some businesses that, it's just the nature of what they're in. And, Berkshire will never get it in a position where it needs money, and we factor in, like I say, we factor in some things that are not ridiculously unlikely, and I'm not going to spell out scenarios because to some extent, if you start spelling out scenarios, you may increase the chance of them happening. So it's not something that we really want to talk about a lot, but our position will be to stay a Fort Knox.
In this clip, Buffett is discussing businesses that, by their nature, require short-term financing when economic conditions are really bad. And he talks about how at Berkshire, they will never be relying on the ability to get money from somebody else in the short term in order to survive. And he also discusses how the airline business and the cruise line businesses are types of businesses that we're seeing now that when there is some kind of complete shutdown, which doesn't happen very often, I mean, it hasn't happened in a very long time, but when it does happen, they are at the mercy of being able to either raise equity, issue more shares and dilute the existing shareholders and hopefully get some new shareholders in at a low stock price, or to find debt in the debt market to get short-term financing. And short-term financing basically just refers to any financing in the debt markets that has a period of less than 12 months. So someone lending the business money over, say, a 6-month period or a 12-month period. To draw an analogy that may make it easier to understand short-term financing, you could imagine that you have a family who has a habit of spending all of their income on their style of living, their lifestyle. So they have a really fancy house, they have a couple of cars on lease payments, and when they are fully employed, almost all of their income or all of their income is going towards fueling their lifestyle. And then you could imagine there was an economic shock that hits the economy and one or both of the parents lose their jobs. Now, as soon as that income source goes away, they still have these expenses that they need to pay. So they would have to go and maybe go to a credit card or some other kind of short-term personal loan in order to cover those expenses. And they are just hoping that the economic conditions will improve before they need to pay back those debts and before the debts get too high. And Warren Buffett avoids businesses who operate in this way. There are a lot of businesses that operate with huge amounts of debt in order to try and amplify the returns to shareholders. But the risk of that is that if there is some kind of shutdown like we're seeing right now with companies like the airlines or the cruise line companies, then they are going to be requiring more debt, and they are praying that this doesn't go on for too much longer, because even with access to new money from debt, it's short-term financing. There's going to come a day very soon where the cruise line companies or the airlines will need to start paying back some of this debt, and if they don't have the money, then they're going to be in a lot of trouble. And ultimately, if you can avoid companies, if you look at companies that have low levels of debt and that always keep cash around on the balance sheet in case of an emergency, not because they need it on most of the time, not because they might not need it for 5 years or 6 years or 7 years, but they keep it there in case of an emergency, of a black swan event. And if you invest in companies like that and avoid companies like the cruise line companies, for example, right now, where they're on the brink of bankruptcy, then you don't have to worry about losing money. And as long as it's a solid business and it meets our other requirements, it doesn't matter if they struggle in the short term, because they won't go bankrupt, and out the other side, their customers will come back and continue to use their products and services, and through that process, you can probably pick up some shares at a cheap price as well.
You really want a business, and everybody wants a business that doesn't take any capital to speak of and keeps growing and doesn't take more capital as it grows. Now, our utility business, our energy business requires more capital as it grows. Our railroad business, to some extent, requires more capital if it doesn't grow even. So capital-intensive businesses, by their nature, are not as good as something where people pay in advance and you don't need the capital. I mean, if you look at where the top market value is in a $30 trillion market, if you take the top 4 or 5 companies that account for, maybe 4 trillion or so of that 30 trillion, basically they don't take much capital, and that's why they're worth a lot of money, because they make a lot of money and they don't require the money to any great extent in the business. We own some businesses like that, but it's certainly not the railroad, and it's not the energy business. They're good businesses. We love them, but if they didn't take any capital, they'd be unbelievable. They're good.
Now, this is a really important clip that I think a lot of people are overlooking, and I really haven't seen anybody cover this topic at all. And this is the topic of the fact that different businesses require different levels of reinvestment in order to A, maintain their business, and B, in order to grow their business, to grow the future cash flows of the business. So he draws an example of some of his businesses, such as the railroad business, where it's so capital intensive that in some circumstances they need to reinvest more capital just to maintain their current earnings. So more or less that means that the return that they're generating on their invested capital is going down over time. And then there are businesses that don't have to reinvest much, so they generate a high return on investment. They don't have to reinvest much to grow, and they can grow at 10, 15, or 20% per year. And what you will notice is that a business that can generate a high return on their investments and doesn't require much reinvestment to grow, those businesses attract really high stock prices, and so they should, because those businesses are the perfect type of business. You want a business where you don't have to reinvest much profit, so you can distribute all of the profit to the shareholders, and it still grows. If you can look to some of the biggest companies on the S&P 500, for example, you have companies like Microsoft, Facebook, Google, Visa, and MasterCard. If you look at all of those companies, all of them generate huge returns on their invested capital, meaning for every dollar that they invest, they generate sometimes 15 cents or 20 cents of earnings on that dollar, which is very, very high. And on top of that, they require very little capital to be reinvested in order for them to grow. If you look at the balance sheet of Facebook and Google, for example, those two companies have both grown at 20 to 25% over the past 10 years. They generate a 15 or 20 or 25% return on their invested capital, and they really don't reinvest that much. Both of them have 60, 70, $100 billion of cash on their balance sheet because most of what they earn just sits in the bank. They don't need to reinvest it into assets or buildings or anything like that, like other really capital intensive businesses require. And that's not to say that you should never invest in a business just because it requires a decent amount of capital to be reinvested to maintain or to grow their earnings. It's just that you need to recognize that that impacts how much you earn from a business, how much it returns to you. If you have a business, two businesses that are the same, and one requires 50% of its cash flows to be reinvested just to maintain the business, just to keep it going, and another business that requires zero reinvestment in order to maintain their business, then this one that doesn't require any reinvestment will be able, it has the ability to distribute more to you, either in the form of share repurchases or dividends, or to distribute to you in, well, it's not really distributing, but to return capital to you by reinvesting back into the business so that it grows, and therefore the stock price and the value of that business will go up and you would benefit from that.
If you print bonds in your own currency, what happens to the currency is it can be a question, but you don't default. The United States has been smart enough, and people have trusted us enough to issue its debt in its own currency. And Argentina is now having a problem because the debt isn't in their own currency, and lots of countries have had that problem, and lots of countries will have that problem in the future. It is very painful to owe money in somebody else's currency, but if I could issue a currency, Buffett bucks, and I had a printing press, and I could borrow money, in that, I would never default. So what you end up getting in terms of purchasing power can be in doubt. But in terms of the U.S. government, when Standard & Poor's downgraded the United States government, I think it was Standard & Poor's, some years back, that to me did not make sense. I mean, in the end, how you can regard any corporation as stronger than a person who can print the money to pay you, I just don't understand. So don't worry about the government defaulting.
Now, in this clip, Warren Buffett is answering a question about whether the US government could ever default on their bonds, because for a very long time, we've taken it for granted that the 10-year US Treasury bond is about as risk-free as it gets. It is risk-free. There's no risk associated with it. So it's a relevant question to ask, can the US government go bankrupt? Can they default on those loans? And he answers it by saying, if the debt is denominated in your own country, so the US's debt denominated in US dollars, then you basically can't, the government basically cannot go bankrupt. And the reason why is because the Federal Reserve can print money and just cover those debt obligations. But that being said, if the Federal Reserve does have to print a substantial amount of money in order to cover these debt obligations, then in economic theory that would result in inflation, which means that the value of your dollar is diminished over time. The purchasing power, what you can purchase with $1, would go down over time. And if that is what is going to play out, which is something that Ray Dalio believes is going to play out, then the best thing that you can do is invest in assets that are inflation protected to some point. And the easiest way to think about this is if the price for a loaf of bread goes from $1 to $3 because of inflation. So you can no longer spend your $1 and buy a loaf of bread. Your $1 now only buys you a third of a loaf of bread. As a consumer, the money that you're using has been devalued. It's gone from, it's gone down 2/3 or whatever. You need to now spend $3 for that loaf of bread. But think about the company that is selling the loaf of bread. They are now generating 3 times as much revenue, 3 times as much sales on that bread. So by holding businesses that are consumer-driven businesses, or businesses that will increase their prices as inflation hits, you will be able to somewhat protect yourself from the inflation and the devaluing of the dollars in your bank account.
I had a woman come to see me here not long ago, and she'd come on some money, and not very much, but it was a lot to her. And she's a friend of mine, and she said, "What should I do with it?" And I said, "Well, what do you owe on your credit card?" And she said, "Well, I owe X." And I said, "Well, what you should do," I don't know what interest rate she was paying, but I think, I think I asked her and she knew, and it was something like 18% or something. I said, "I don't know how to make 18%. If I owed any money at 18%, the first thing I do with any money I had would be to pay it off. It's going to be way better than any investment idea I've got." And that wasn't what she wanted to hear. And then later on in the conversation, she talked about her daughter, and her daughter had $1,000 or $2,000 or something, and she said, "Well, what should I do with?" And she named the girls money, and I said, "Have her lend it to you." And I mean, if you're willing to pay 18% or whatever, she's not going to find a better deal. I'll lend you money. It just doesn't make sense. You can't go through life, borrowing money at those rates. And
this final clip was towards the end of the Q&A session, and Buffett is answering a question around credit cards, and he explains the idea that if you have any kind of credit card debt or high interest debt, really any kind of debt that's probably above 8%, I would say, or maybe even above 6%, any debt like that, if you just pay that off, you instantly make that return. And therefore it makes no sense for you to be investing in the stock market if you have high interest credit card debt, for example. And the easiest way to sort of think about this is that the reason why you make a 15% return instantly if you have credit card debt that has an interest payment of 15% is that if you pay that off, you no longer need to pay 15% interest. You're saving yourself 15% interest, and as a result are generating a 15% return on the money that you use in order to pay down that debt. And this is kind of a core lesson in that when you are looking to invest, if you're interested in investing, the first thing you need to do is really a couple of things. One is you want to have an emergency fund, because you certainly don't want to be caught in the situation where you need to sell your investments in order to pay for something that's urgent. And then the other thing is that you need to pay off any high interest debt before you even consider starting to invest. If I had credit card debt, I don't have a credit card, but if I had credit card debt of 12% or 15%, that's an instant return that I can make. And there's no point me putting my money in the market where I may or may not make a 12 or 15% return, when I could put that money, pay off the debt, and guarantee that I save myself 12 to 15% in interest every single year. And those were the 5 clips that I wanted to share with you today. Let me know down in the comment section below if these were clips that you hadn't seen yet. I know that this topic has been, Berkshire Hathaway's meeting has been covered thoroughly at this point, so I'm sure there is some overlap, but hopefully I brought you some insights that weren't covered too many times by other people. So, and if you did enjoy the video, of course, as always, let me know by leaving a like and hitting subscribe if you want to see more content like this. But other than that, I hope you guys have a great day, and I'll see you in the next video.